I always put a marker at the open of the week because it becomes a magnet very often later in the week. So I snap this to the open. And we had a couple really impressive days last week. We had a small gap up, but a strong bull trend and then a good follow-through day. I think it's more obvious on the daily chart. The bears had an attempt at a wedge here, but the shape was not good. 1, 2, 3, or 1, 2, 3. And I said we might get a third leg up before the bears can get a wedge. And I also said I thought we would get about 4,000. Well, we've done both. However, we have a very big breakout bar. A breakout bar is a bull breakout bar. It's a bull bar closing near its high and closing above the high of the prior bar. And here it also closed above this high, and it closed above the high of the past, 50 bars or so. And then we had a bull follow-through bar. And so that's good. That increases the chances we'll get a little bit more up. We have a possible wedge, 1, 2, 3 at 4,000. That has been the most important price for a year, since April last year, when the market gapped up above 4,000 on the monthly chart. We have this low here, that up here. I talked a couple times about how we had consecutive expanding triangles on the daily chart. We have 2 highs and 3 lows. Instead of successfully reversing up, we broke to the downside, and then we got 3 more lows, 1, 2, 3, and 2 more highs. And I said over back in here that the bottom was not good. We probably would get 1 more low. And then we had a very dramatic low here on October 13th. At the time, I said 50-50 chance it'll be the low for the year, and that we could rally into the year end. The bulls are hoping that'll be the case. The bears are hoping that this will be a wedge, a 50% retracement, maybe a test of the bear trend line, and then we'll sell off at the end of the year. I don't know. We're in a seasonally bullish time of the year, middle of November to the end of the year. Yeah, this is overdone. We may pull back for a few days. We may dip below this breakout point, but it's too early to be thinking about shorts. The bears would need at least a micro double top, something like this. Very strong rally, first reversal down minor, then we had a lower high, and then a reversal down. Very strong rally, first reversal minor. We had 1 more test up. This to a higher high double top, this to a lower high double top, this to a higher high double top. So we're probably, bulls are going to buy the first pullback, whether or not it dips below that November 1st high, but they're going to buy the first pullback. The rally is so climactic that we're probably going to go sideways for a few days like this. When the market gets extreme like this, it tends to go sideways for 2 days, 5 days, like that, like this, sideways for 4 days. Here, very extreme, sideways for 3 days, sideways here for 6 days, sideways for 6 days, sideways for a couple of weeks. So we're probably not going to go straight up from here, even though it looks like we're going to get to this bear trend line at some point this year, probably in the next few weeks. We ended Friday with a buy climax, a spike pullback channel. The channel began here, so that's a magnet. We have a double top. The bears want the measure move down from the neckline, which would get us down to this general area. Do we need follow through again today? No, the breakout was on Thursday. This was the breakout day, Thursday, and we had and it closed above resistance. It closed above the high of the past 50 days. It closed above a major high. We had a very strong sell-off on that high. Then we had a second bull bar closing above that resistance, and the second bull bar closed near its high. So this is a strong enough breakout so that bulls will buy the first reversal down. Bears will not sell the first reversal down. Well, if bulls are not going to buy the first reversal down, what would cause the pullback? Profit taking. A lot of bulls see a potential wedge at resistance, and they see this as climactic, so they'll take some partial profits. And if enough do, then today we'll drop below yesterday's low, or tomorrow we'll drop below today's low, and we'll get a pullback. But there are other bulls looking to buy the first pullback, like this. Very strong rally. They pull back for a day. Here, pull back for a day. Strong rally. They'll probably buy below the low of the prior day. Monthly chart. If you remember, back on November 1st, I said we went above the December high and we probably would pull back, which we did. And I said we probably will get back above the December high at some point in the first couple of weeks of November. And we're back above that November high. The bulls are hoping that this is a wedge bottom, 1, 2, 3, with a really good buy signal bar. It's a breakout test of this high, a test of the pre-pandemic high, and it's a good-looking bull bar. So we're probably going to be sideways to up for at least 2 or 3 months, and possibly this will go all the way up to a new high. I think the sell-off is so big that the first reversal up there'll be a lot of traders who bought up here thinking it would be a brief pullback. It became a big pullback, and a lot of these bulls would be relieved to get out around here. Now, why would they get out around there? They bought here hoping that we would continue doing this, or that we'd get a 1-bar pullback and then resume up. Instead, they got this. So now they're thinking that instead of a strong bull trend, we might be in a trading range. And if it's in a trading range, they want to exit longs near the high. They bought here. They might buy more here, but if it gets up to this area, a lot of these bulls will be exiting, thinking that it's now a trading range instead of a bull trend. So if we do get up here in the next 6 months or so, we'll probably stall for at least a few months here. We broke above the pre-pandemic high and sideways for 4 months. So if we do get up there, we'll probably be sideways for several months. It'll take several months to get there, and then several months there. So it probably will be at least a year before we can go much above this high, if we ever go much above this high in the next several years. This may be the start of a trading range like we had back here in the 2000s. Here's 2000. We got a new high. We had a very strong rally, but it failed, and we got a 56% correction. Trading range, double top, double bottom, breakout mode. Usually the trend before is the one that resumes, so we got resumption now. We still have 2 weeks left of the month, and the high of last month is still a target. Right now, it does not look like we'll get down to the high of last month, but we might. It's way down. Last month is still a target. Right now, it does not look like we'll get down to the high of last month, but we might. It's way down. I don't even have it. Let me just check that. Put up a 60-minute chart. Okay, yeah, I erased it because it's almost exactly at the November 1st high. I have it there. Okay. So it's down around 3,900. It's certainly within reach. Okay, 5-minute chart. We broke below the neckline of a double top, but we have an unclear bar. It has a bull body, but it did not close on its high and did not close back above the breakout point. I talked about this last week. If you have a gap up in a bear bar, not too far from the moving average, usually you're going to come down to the moving average, and like this. To me, that's sell the close, looking for a test down to the moving average. And today, it's the opposite. It's a small gap in a bull bar, so we're probably going to go to the moving average, and bull scalpers will buy that close. And not so easy to see, but the bulls who did buy the market on the close of 1 were able to make 5 points. What do you do here? Well, if you're a scalper, you just had your trade. You buy as soon as 1 closed, you place a limit order to buy at the close of 1, you would have been filled. Or as soon as 1 closed, you place a market order, just buy at the market, and then place a limit order to get out 5 or 10 points above. The bulls are hoping today will be like Thursday and Friday, that we're going to go up in a small pullback bull trend. And we might, but it's more likely we're going to form a higher low and then get a second leg down. We've had 2 climactic days, and a third bi-climax day is very unusual. So it's unlikely today is going to do this. It might do it for 2 hours, but it's not going to do it for 4 or 5 hours. And very often when you get a double top, and you get a rally, and it forms a lower high. So even though the high of last week is an obvious magnet, the bulls want confirmation of last week's big bull bar, weekly chart. Bulls want this week also to be a bull bar, and they'd like to break above last week's high. We got the bear trend line. We have the top of the sell climax, both our targets. And I think we're going to get there, but not necessarily this week. Okay, we've got two important prices right around the same place. I'm going to get rid of this measured move. But with a really good gold bar like that, we might have to get above last week's high early this week. Do I think we'll get there today? I don't think we're going to get there in the first few hours today. I think this is going to be a double top pullback, and we'll get a second leg sideways to down. Now, we have consecutive bull bars, one being big and closing near its high. So is this by the close? It is. So theoretically, if you're trading like Forrest Gump and you don't want to give much thought to things, this is a reasonable buy the close. But as I said, we have consecutive buy climax days, and we have a double top. So we're probably going to form a lower high. So it'll be a double top pullback, and we'll get a second leg down. If 2 is buy the close, can't you buy at the market here? We're 5 points down from the 2 close. You can, but I think it's probably better to wait. We're right below the moving average, right below yesterday's close, and we're probably not going above yesterday's high during the first leg up. So that means realistically, you can make 15 points if you're lucky, if we get up that high. I think I'm trying to remember who I told. As you know, I think the bond market has seen the high for your lifetime, right? But I told some friends last week, who did I tell? I told some people. Last week I did buy bonds. This is the first time I bought bonds since last year. And I bought when the market started to reverse up on I call it the low day. Good area to take some partial profits, but this low is probably going to be holding. It's probably a double bottom. If we sell off, we'll get a double bottom pullback and a second leg up. This is so extreme that we're probably going to drift higher. This is the bond market daily chart. Here's the monthly chart. And look where we are. This general price area was support here for 5 years, and we're into that support area. So I don't think we're going to collapse much further. We already have 3 legs down, 1, 2, 3. Really strong climactic sell-off. It might get a small second leg down to a micro double bottom, but we're probably going to be sideways to up in the bond market for the next many months. And then the dollar index, I'm sure you're aware, put up the daily chart. Really blow off top. There's the daily chart. We have a double top pullback, or you can call this a double top lower high. Strong break below the neckline of a double bottom. Probably we'll get some kind of a measured move down. We're already a measured move based on the double top, but this is strong enough, so we'll probably go lower, maybe down here. And that's the opposite of what's taking place. I'll put up the Euro futures. Opposite of the Euro futures daily chart. Higher low, major trend reversal, double bottom, higher low, a breakout above a double top. Probably we'll get at least a small second leg up. Now, I said that 2 is a reasonable buy the close, and I said I wouldn't do it because the math was not good. For the bears, they're hoping that 2 is a bull trap and that this is the start of a bear trend day. What about selling below 3? It's outside down, and it went pretty far below 2. It broke to a new low of the day. It's a reasonable short, but I'm going to wait. Bar 1 is a trading range bar. We went up, we went down. And then we went up on 2 and down on 3, so another trading range thing. And we're right in the middle of yesterday's range. We have a spike pullback channel. The market typically breaks below the bull channel and then evolves into a trading range. It sometimes gets about halfway down, which is where we are, and then starts to go sideways. Other times it gets all the way down to the start of the channel and then bounces and goes sideways. Now, what about selling below 3? It's a new low today. It's a reversal. We're just above the Globex low, so we're probably going a little bit lower. Here's the Globex low. What do you notice about the Globex range? It's small. We're in a tight trading range. It's a small range. And on any day, without knowing anything about what took place in the Globex market, there's a 90% chance that we're either going to go below the Globex low or above the Globex high. And when the range is small, like it has been, like it was last night, the chance of breaking onto that range is even more than 90%. And sometimes when you have a small range, you break out of the low and the high, which we might do. So a small range, you got to be thinking it's possible we break below the low and then above the high. Bears see a double top. Bulls want a double bottom. Bears want the measure move down, which would get us down to this area, 3960, which is in this general area near the start of this channel on Friday. Are we always in long or short? A lot of bears would like to see a second consecutive bear bar, especially with the trading range behavior. Now, if we get a good bull bar 4, we have a lower low double bottom 1 and a wedge with 70 and 1, but we have a bear surprise 3. Right? It was by the close 2, and we went below the low, so all the bulls theoretically gave up. So that's a low probability event. Low probability event is a surprise. The surprises typically get second legs down. This to me looks like a trading range open. We started to get a trading range on Friday, since here. Rally, we tested the bottom of that rally, tested the top. We're breaking below the bottom, but we rallied, we sold off, rallied, we sold off. We might try to rally again. We dipped below the Globex low, you can see over here. Now, for the bulls, this would be a high 2. 2 attempts to reverse up from below this neckline of this double top. What would traders need to see for to make them buy? Well, they got a really impressive bear bar 3, so the bulls would need something as impressive. They would need a very big bull bar closing near its high. So we're probably not going to do what the bulls need with 4, and that means there probably will be sellers above 4. Suppose 4 looks like 3 yesterday. Can you sell the high? Similar circumstance. Different. That was above the moving average, and it was a bear trap on the open. We've already had a bull trap on the open, big bull bar and a reverse down to a new low. So, I'm not going to do anything here. I need more information. If 4 is a huge bull bar closing near its high, I might buy it. But anything less than that, I'm not going to buy it. A lot of traders suspect we're going to test down here at the start of this channel. Spike pullback channel. A bull channel is a bear flag because 75% of the time you break below the channel and not above the channel. And then you evolve into a trading range. If you sell here, the close of 3, below 3, your stop is above 3, and you're looking for at least a measure move down based on the height of 3, which would be somewhere down here. And if 4 is a bear bar closing near its low, if it's simply a bear bar, then we'll have consecutive bear bars, one big and closing near its low, bar 3, and it would be theoretically sell the close, but your stop would be above 3. So you're risking 20 points, $1,000 per E-mini. So if you do sell the close of 3, you have to go to stop above 3. I think it's probably not great to do unless you can trade small. I often talk about having 2 position sizes. One, your normal size that you take on most of your trades, and then a second size when you look at the market and you say, it looks like a good trade, but I don't want to risk that much. And this is an example. Bar 3 is very big. If you sell below 4, you're risking 20 points, and that's more than what you typically risk. You should have a second position size. And the second position size should be, I think, 20% of the size of your first position. So if you normally trade 1 E-mini, 20% of that is 2 micro E-minis. 1 E-mini is 10 micro E-minis, so 20% of that is 2 micro E-minis. And, I understand you say, well, it's not worth it. If I normally trade 1 E-mini, I don't want to trade 2 micro E-minis because I'm not going to make much money. It's not worth it. It is worth it because what you do is you build a position. Similar to yesterday, if you bought above this, thinking, it's probably going to stall here or stall there. You buy 2 micro E-minis. Bull bar closing in its high, buy 2 more, buy 2 more, buy 2 more. And all of a sudden, you have your full 10 micro E-minis, which is equal to your normal position size of 1 E-mini. And once you're up here, your stop is tight. And even if it were to fall, you get out long before you lose money. So once you start to build a position, you raise your stop, and you're in a good position to not lose money, and you'll probably make money. So you can see we have a high 2 with bar 1, a lower low double bottom 1, a wedge with 70 and 1, but we have a reversal bar. It's a perfect doji, open at the close of 4, so it's not a bear bar, but it's still confirmation of 3. The minimum confirmation that the bears want after a bear surprise bar is no bull body. And 4 is a perfect doji, so it has no bull body. And that is confirmation of 3. And it increases the chances that we're going to get a second leg sideways to down. 3 has a problem. It's not perfect. It did not close below 1. 4 did not close below 1. So sell the close, yes, but really not all that strong. And what's most likely after a climactic rally is a trading range. So if you're going to be selling high, you want to make sure you're selling really high and that the buy setup is really bad. And this is not, I don't know, most traders I think should not do this. Also, most traders should not be trading with limit orders. But the correct, if you're trading, strictly taking signals, you'd sell below 1, you'd sell below 3, you'd sell the high of 4, stop above 3, looking for a second leg sideways to down. Also, since the trading range is likely, you got to be thinking scalp. So traders should be looking to exit with 5 or 10 points until we're in a clear trend, until we start doing this, 3, 4, 5 bars in a bull micro channel, 3 or 4 consecutive bull bars closing near their highs, here and then here and then here and here. Until we start to do that, you have to assume we're still going to be in the trading range. What happens if 5 closes near its high? We still have the high 2 buy with 4. We have that bear surprise 3, and we have the moving average just above. So I think best choice wait. Bulls are hoping that this is a failed breakout below the Globex low. Broke below the Globex low. They're hoping we'll reverse up and go above the Globex high. Remember, the Globex range is small. So normally, once you break below the Globex low, there's only a 10%, maybe a 20% chance you'll break above the Globex high. But when the Globex range is small like this, it's probably 30% chance, or maybe even 40% chance that you'll break above the Globex high, and that you'll break out of both ends of the Globex range. $7 is often a report, and that makes bar 6 sometimes tricky. You can see Friday bar 6, look what happened bar 7. It went below, it went above, right? It's just really difficult to place stop orders above or below 6. And then if you have a quick move on a news announcement or a report like we had on Friday, it's very difficult to manage your trade. It's easy. At the end of the day, you look at the bar and say, oh, it's a bull doji bar. If you bought the 6 low, looking for a second leg up after 4, you put a stop below 3, and you would have made money. But that's easy to say once you see all the bars to the right of 6. When you're trading it real time, this was a huge bear bar, at least briefly, before it reversed up. So hard to do. So here we have a high 2 buy, a 50% retracement of Friday's rally, but nobody's buying, right? It's trading range. Up on 1, down on 1, up on 3, down on, up on 2, down on 3, down on 4, up on 4, up on 5, down on 5, right? What does that tell you? We're getting reversals on every bar or 2, and that means traders are taking quick profits. And not only that, you have opposite traders looking for any attempt to begin a trend to fail. So at one point, 1 was a big bull bar, bears sold it. And then bar 2 is a big bull bar, bears sold it. Bear 3 is a big bear bar, bulls started to buy, right? 4 was a second consecutive big bear bar, bulls bought, and it did not end up as a second bull bar. Now I said 2 was a reasonable buy the close bar. So we're probably going to get back to the 2 close. Whenever you do something that's reasonable, and you use a wide stop or no stop, and then scale in, 80% of the time, you can avoid a loss. Traders have bought the close of 2, bought the low of 1. We're probably right around the midpoint of that right now, so they're probably able to get out without a loss. So an aggressive bull, we bought the close of 2, and then if you bought the low of 1, look where we are. And that's why we're doing that, right? You had some bulls that bought the close of 2, they bought more at the 1 low, betting the breakout would fail, and then their average price is here, and we went just a little bit above the average price and sold off. And part of that is, I think, from buy the close bulls 2 who added on at the low of 1, and now they're getting out break even on their trade. I was just checking my positions. I have several positions that I put on last week. Everything is good. Now the bulls are trying to get a breakout. You can see the close of 5 is above the high of 4, so that's a breakout. But I would not call it a breakout because 5 did not close near the high of the bar. For a bull breakout, I want the close of the bar above the high of the prior bar, like 2 closing above 1, and I want the bar to close near the high of the bar. 3 broke below 2, but did not. You can argue it broke below 1. It did break below 1, but it did not close below 1. So that is not a strong bear breakout. Now, what happens if we start to do this, a bull microchannel, and we start to get 2 or 3 bull bars closing near their highs? Then it could become buy the close, always in long again. But right now, this is probably a bull leg in a trading range. The bulls are trying to get back to that 2 close. And it was reasonable to buy the close. We had consecutive bull bars, 1 big closing near its high. And the bulls who bought the close of 2 or bought above 2 never had an opportunity to get out. So they'll buy more lower, trying to get back up there. So that's where we're headed. 6, a multiple of 3. This is bar 6, a multiple of 3, so it corresponds to a 15-minute bar. And for the bulls, they're hoping this is 2 legs down, 1 pullback 2. They want a good buy signal bar, and they want the bull trend to resume. You can see the 15-minute bar on the Globex market here. I've been putting a yellow dot on top of bar 41 because it's fairly common for the market to reverse or break out around bar 40. So that's just a reminder. All right, so now we have 5 closing above 4, but 6 did not close above 5. So we're trying to rally. Right now it's a 4-bar bull microchannel. We have a 4-bar rally, and the lows of the bars are above the lows of the prior bars. Bulls are trying to get a breakout 7. They want to close above 6 and then possibly a measure move up to yesterday's close. $4,000 big round number. I've talked about that. I've been talking about that since last year. Last year, we had a gap up over here in April above the March high and right around 4,000. And on the daily chart, we did gap above 4,000. So what just happened here? We get back to the 2 high and to the 2 close. So the bulls who bought the 2 close or the 2 high are relieved, and a lot of them are selling. Some are willing to take a tick or 2 or a point or 2 loss. So some of the buy the close bulls 2 place limit orders to get out a point or so below the close of 2, just in case it didn't quite get back to the 2 close. You also have the moving average bears with limit orders at the moving average, betting that we're in a trading range, and therefore if you get a test of the moving average, you're probably going to reverse down. And then you also have the 50% bears, or around 50% retracement of the sell-off. Now, what about the bulls? Obviously this could be the low of the day, and we could rally all day. And we're going up, so if somebody's buying, a lot of the buying is bears buying back shorts, hoping that 3 was going to be the start of a big bear trend day. And then some of the buying is high frequency trading firms. They knew when we were here that we probably were going to get to the 2 close, maybe the 2 high. So they start to buy, looking for a point up, 2 points up, 5 points up. And they'll continue to buy, even up here, betting that we'll get the final 1 or 2 ticks. So the high frequency trading firms, their algorithms will buy looking for a 1 tick profit. If we had 4 or 5 consecutive ticks, each tick above the next, some of those algorithms will say, well, we'll probably go 1 more tick, and they'll buy for a 1 tick profit. And then they'll buy more on a 1 or a 2 tick pullback, betting that the first pullback will fail. So it's the same trading that we're doing here. So when you see this, you know they're going to buy the first pullback. And if this was a tick chart, or where every bar is going to be 2 ticks, or 1 second or something, some small time frame, it's the same thing. Once you have a whole bunch of bars, every low at or above the low of the prior bar, traders are going to buy the first reversal down. That first reversal down, I'm going to take a look at the 1 minute chart. Okay? Strong rally, they're going to buy the first reversal down. And we've got a second leg up, that was likely. And strong sell-off, they'll sell the first pullback. So they'll sell that high. Strong rally, they'll buy the first low. Right? And that's true on all time frames, daily chart, monthly chart, 5 minute chart. It's the same logic on any time frame, yearly chart. Very strong rally. Probably traders will buy the first reversal down. Bulls will take profits on the strong rally, but other bulls will be looking to buy the first pullback. And the bears know there probably will be at least a small second leg up. So the bears are not going to short the first reversal down. They may sell at the top of the buy climax, but they'll buy back their shorts below the low of the prior bar, the first reversal down. Bulls need a breakout. They want 7 to close near its high, on its high, above 3, breakout high of the day, and above the moving average. If they get that, then we might be able to go up to yesterday's high. Right now, as I said, I think it's more likely we're going to form a lower high. So we may get very close to it, but we're probably going to form a lower high. And if we sell off from that lower high, then maybe the bulls can get a rally to a new high. But the first rally probably will be a lower high, double top pullback. Double top, reversal up, it's a pullback from the reversal down and run lower. Here, a very big double top, a rally that lasted about an hour or so. Very strong bull bars, yet it was simply a pullback from this reversal down. Double top pullback, second leg down. Okay, here we got a small double top. The bulls tried to reverse up again, and we got a lower high, so double top and a pullback. Here we got a double top, a strong rally, pullback. And after you get that reversal down, then you can go higher. So this is similar to the kind of thing that we might get today. Right now we're in here. I think we're probably going to get a pullback. If we go down, traders will be more willing to buy a reversal up, and the bulls will have a better chance of breaking above the double top. That's my encyclopedia of slides. For 35 years, I've been categorizing charts. I used to have paper folders and paper charts, and about 10 or 15 years ago, I started doing it digitally, and looking for patterns every day. And every day is multiple patterns. I could call this a triangle. I could call this a bear trap. This is a small pullback bull trend. It's a double top pullback, a failed double top here. So what I would do is make a chart for each one of those patterns, and then put the chart in the appropriate folder or appropriate PowerPoint. So in PowerPoints, I have a whole bunch of categories: double top bear flag, a second sell signal, a failed double top, bear flag, disappointed bears. I got probably about 500 different sections in the PowerPoints. I like it. I still use it today because it allows me to quickly get an idea of what's likely to happen. Bulls, they need a breakout, a close above something. 7 closed above 6, but not above the moving average, not above the high of the day, and had a big tail on top. They're trying again to get a breakout here. They're trying to get 8 to close above 7, and then they hope it'll be a failed double top, and we go up for a measured move to above yesterday's high, and which was also Friday's high, high of last week. And what happens if we get up there? Well, if we get up there, we've had 2 climactic days. And what did I say about the chance of a third climactic day? Small probability, maybe 20% chance that today's going to be a small pullback bull trend day. We're right at the Globex high, and we just went above it. Remember I said we had a very small Globex range, and when that happens, there's an increased chance that you break below the bottom and above the top. We're very close to yesterday's close, so we're probably going higher. Bulls, is it by the close yet? It probably is with a close of 7, but your stop is below 4, so it's the same problem with buying the close of 2. Wide stop or selling the close of 3. Anybody buying the market on the close of 8 or buying one tick above 8, stop theoretically below 4, but you're not going to risk that much. You'll get out below a bear bar closing below its midpoint. You'll get out below a bear surprise bar like bar 3. So it's very unlikely that you'll have to rely on the stop below 4. Again, big risk, so you trade small. There will be some profit takers around 4,000. Some profit takers around the close of yesterday. The market has been in a trading range now for, I guess, 7 months right now. Is it 7 months? Around 4,000. Each of the past 7 months has tested above and below 4,000. And here we're back at it again. Last month, October, did not touch 4,000, but all the other months did. Bulls want this to be as bullish as possible. They got the minimum. They got a close above 7 and a close above the moving average. But the tail, tails on all of ours, 4, 5, 6, 7, 8, reduce the chances that this is going to be the start of a big bull trend day. Right now it's by the close, by the market. What happens if 9 is a bear bar closing below its midpoint? We'll have a higher high double top 3. Bulls will get out, but this is a big enough reversal. We'll probably get a small second leg up. So it looks like we're going higher. We should get at least to 4,000 and at least to yesterday's close. Yesterday's high, I say yesterday, anything to the right of this line is today, and anything to the left of it is yesterday. I referred, when I talked about today and yesterday, I'm thinking in terms of trading days. So this was the prior trading day. Instead of saying the prior trading day, I just call it yesterday. Testing yesterday's close, testing 4,000, testing the Globex high, but we have now 6 bars without a bear body, 7 maybe with bar 9. I would not sell below 9 despite a higher high double top 2. We had a bear surprise 2 and no second leg down. So the rally is a bull surprise, and chances are we'll get a second leg up. So the bears will probably need at least a micro double top. You can see disappointed by the closed bulls. They're concerned that we're not breaking strongly above 4,000. We're not breaking strongly above yesterday's close, yesterday's high. Is there any reason to short below 9? No. Can the market do anything with 9 to make traders short? No. So no matter what 9 looks like, it's better not to short, despite a higher high double top, a test of yesterday's close, a test of 4,000. Nobody willing to sell. Now we have, 7 bars and a bull microchannel. The reason why traders would buy, even though we're at a price where the market stalled on Friday, is that traders are confident that one of 2 things will happen. One is we'll keep going up and break strongly above yesterday's high, which is last week's high, which is also a double top, and they'll be able to make money. Or it'll reverse down, but if it reverses down, it'll be a minor reversal. So if you're buying here, you buy small, put a stop below 4, and you buy more, 5 or 10 points lower, 15 points lower. To do that, you have to trade small enough so that your risk is not any greater than on any other trade. Remember, the chance that today is going to be a third consecutive small pullback bull trend day is probably under 20%. And therefore, whatever rally we get is probably going to fail at some point today, probably by the middle of the day, bar 40, 41. And we do not even know if it'll last that long, but it's unlikely that we're going to have a third consecutive big bull day. The bulls are trying to get above last week's high, which was yesterday's high, Friday's high, a daily chart. We have consecutive bull bars, both closing near their highs and both closing above a significant resistance place or point here. So we broke out 2 closes above this breakout point. This was a strong reversal down, yet instead of continuing down, we went above it. So we broke above a major lower high, and the bulls want a measured move up from this low to that high, back up to here. And if we do get up there, and let's say we get up here and fail, then this expanding triangle becomes bigger. So down and up, more down and more up, and more down and more up. And it's pretty common. An expanding triangle is a trading range, and you keep getting reversals, except they tend to come at new lows and new highs. So if we do get up here, don't be surprised if we reverse again. Because of those consecutive expanding triangles on the daily chart, I think we've probably seen the low of the year. Also, you can argue from a fundamental perspective that we have a mixed Congress, Democrats holding the Senate, Republicans holding the House, and therefore there's very little chance that any stupid, expensive anti-business legislation is going to get passed. So there's a relief rally. Now, the market is really good at anticipating stuff. And when I say that, I want to talk about the daily chart. No, we'll go over here. Okay. Now, when we were selling off here in September, I said the market often has a big sell-off into October and then reverses up to the end of the year, sometimes into April and May. And so on the 13th, when that happened, I said that's a good candidate for the low of the year and possibly a rally that could go into May. And you hear sell in May, go away. Well, when do you buy? If you sell in May and you go away, well, you buy in October. Traders look for a big sell-off in October, and they got it on the 13th. I was talking about how the market is really good at reading tea leaves. Okay, I'm going to go back to what I was saying. I was saying that the market is really good at anticipating things. And okay, now this, okay, near the end of the hour, the bears want this to be a double top pullback, but 6 consecutive bull bars and a 7 or 8 bar bull microchannel. Traders are going to buy the 10 low. They'll buy more, 5, 10, 15 points lower. They'll buy with limit orders at the moving average. They'll buy with limit orders at the 3 high. Now, I'm mentioning the 3 high because it's important. In strong bull trends, the market tends to not pull back below breakout points. You tend to get gaps, and that can result in bull trends that last all day. If you do get pullbacks below breakout points, it increases the chances that here, okay, there's a gap between that low and the breakout point. the gap between this low and that breakout point. Chances are you're going higher. Here, on the way down, there's a gap below the pullback and the breakout point. Chances are we're going lower. Now, why would we go up on 11 when it has that big tail? Because it's still by the close, although instead of buying with a stop above 10, you'll get traders buying the close of 10 when you have a big tail like that. Everybody knows there are buyers below 10, and traders are afraid it may not come down until 11 or 12 or 13, and so there's more profit for the bulls. Most traders, I think, should stop buying, at least temporarily. We might get a double top pullback, and there will be buyers below 10. What did we do at this price on Friday? 48, 30 bar trading range. And we broke below it, reversed up. Now we're near the top of it. We may go sideways here for a few bars. I want to go back to what I was saying about the daily chart. The market is really good at anticipating events. And this low here in October was probably a lot of institutions deciding that it's too low to be selling, and the market, the Democrats are not going to win both the House and Senate, and therefore we're not going to get a bearish scenario, yet we're really low. So a lot of the institutions bought here. They bought really aggressively. They bought really aggressively again here. So I think they were saying that they think either the Republicans were going to win both houses or they'll win at least one of the chambers of Congress. And all they need is one to stop Biden from doing stupid things. So a lot of this, I think, was anticipation of the election. Some of it is what I said. Traders look for a big sell-off into October and then a rally into the end of the year. But this, I think, is probably a lot of smart money betting that we were going to get divided government and therefore no stupid expensive legislation. All right, so now we have a micro double top, 10, 11, higher high double top, 2, failed breakout above 2, test of yesterday's close, failed breakout above yesterday's close, failed breakout moving average, failed breakout 4,000, but probably buyers below 10. Traders buying the 10 low need a wide stop, especially after a micro double top, up on 10, down on 10, up on 11, down on 11. This is bar 12. It's the final bar of the first hour, so it affects the appearance of the first bar. The bulls were hoping for a big outside up bar. Instead, it looks like we're going to have a bar with a tail, just like the past 2 hours. Increases the chances that we're going to be sideways here, that we're going to have more sideways bars. Any reason to short below 11? Not a good reason. I would not sell below 11. Probably traders buying, looking for reasons to buy. Buy the 10 low, buy more 5, 10, 15 points lower. Buy the moving average. Buy the 3 high. Now, bar 4 is the problem. Okay, do you understand what the problem is with bar 4? It's the low of the day. But what's the problem? It's a bad buy signal bar. And when you have a bad buy signal bar, you'll have some bears selling the high of the bar and selling more higher, 5, 10, 15 points higher, betting on one of two things, that the market is going to dip below that buy signal bar and they can get out break even on their first sell with a profit on their higher sell, or then it will come at least halfway down. So if you sold the high of 4, you get filled here, and then you wait for a bear bar closing near its low, and you sell below that, and you're betting there's an 80% chance we're going to dip at least one tick below that midpoint. I don't have this drawn in perfectly, but it's pretty close. So you buy that, you sell that high, sell more 5 points, 10 points, 15 points higher, or you sell more on a bear bar closing below its low. You sell below that bear bar, so right around there, and this is their average price. So the bears who took this sell are really disappointed by this. So they're no longer hoping to make money. They're hoping simply to avoid a loss. So they'll get out when the market gets here. So there'll be bears buying here. Bulls know that, so you'll get some bulls buying here as well. And then you'll have bulls and bears buying here. If it gets all the way down here, the bears are sold here and sold more here, can get out, break even on their first sell, and with a big profit on their second sell. And the bears who started selling here can get out with about 10 points. So there'll be buyers at the 4 high if we get there. What do you do right here? I think that kind of trading, all of the stuff that I'm talking about, is not the kind of thing beginners should be doing, because it's really difficult to manage. If the market doesn't do, I said 80% chance you can get out break even, so 80% chance we're going at least a tick below that midpoint. But what happens about the 20% chance? So if you sold high 4, you sold below 11, and it gets down here, and instead of going down, it reverses up. What do? Right? And that's where that 20% of the time when it doesn't work is where you lose so much money, it erases the profits that you made during the 80%. So this is not the kind of trading most traders should do. If you have a big enough account and you can trade small enough, you can do it. This is the end of the first hour. The hour opened here at the open of R1, which is also the open of the week. Now, why are we getting a little tail? 12. Some of the bears who sold the 4 high and sold below 11 are concerned that it might not quite reach that pink line, so they're scalping out with 5 points. That's what's causing that bounce. And you have limit order bulls who bought the 10 low, bought more 5 points lower. They're looking to buy. For example, they bought at the moving average, or they bought at the breakout point, the 3 high. Remember I said, if today was going to be a strong bull trend day, we probably would not dip below the breakout point, the 3 high. We dipped below the 3 high, so today's probably not going to be a strong bull trend day. Can you buy above 12, a high 1, and a pretty strong rally, a 50% retracement? The bulls would need a pretty good bull bar. Consecutive bear bars, at least one with a big body closing near its low. Is this sell the close? Nope. It's similar to 1, 2, not buy the close. Similar to 3, 4, not sell the close. Probably we're in a trading range, and it's slightly more bullish than bearish after that rally. So probably sellers above 12. Probably some buyers at the midpoint of the 2 sell entries, and probably more buyers at the 4 high, which is right around the open of the day and the open of the week. So limit order traders, limit order bulls, buy below 10. 10 is a bad sell signal bar, just like 4 is a bad buy signal bar. Just like the bears sold the 4 high and sold more higher, bulls bought the 10 low and bought more lower. So we're going back above the 10 low, but we may drop below this pink line, and we may get down to that 4 close for 4 high first. You can see what kind of limit order day this is today. By the close bulls 2, you had to have a wide stop and scale in far below, but if you did, you were able to get out break even when I got back to that 2 close and then profit on your lower buy. And for the bears who sold here, they had to use a really wide stop or no stop at all. They had to sell more higher. Bulls who bought the 10 low, they'll probably make money as well. So it's okay to be long, okay to be short. If I were trading with wide stops, I would rather be long. I think it's more likely that we're going to go back above the 10 low than it is that we'll get below the 4 high. But, we've been in a trading range now for 50 bars since bar 48. So it's a limit order market, lots of reversals. And a lot of times in trading ranges, stop entries just don't look good. And when that's the case, it's usually better to wait for second entries. 4 is a second entry, but, I think not great. 10 is not a second entry. 4, you can say it's a second entry with 2, except 4 went below 1, so 4 is the start of a new leg up. So I would call 10 a first entry. You can see the limit order trading. We went above the 10 low, and the bulls have bought the 10 low and bought more 5 points lower. Sold, and that's why we're pulling back here. Not many bulls want to buy on a stop above 12, and the bulls have bought the 10 low are happy to get out, break even at the 10 low and with a 5-point profit on their order from 5 points lower. Some bulls did not buy the 10 low. Instead, they placed a limit order at the 3 high, betting that we're in our trading range and we would dip below a breakout point, the 3 high. So they bought the 3 high and then scalped out with 5 points. And limit order bears sold the 12 high, betting that we're going to get at least to this pink line, maybe all the way here. And they'll scalp out with 5 points. Not a good buy signal bar 12, not a good buy signal bar 13. Always in long, plus we have that magnet here. What happens if 14 closes near its high? We're probably going higher, but we're not getting good buy signal bars, so I think it's better to wait. Can you sell the 14 high like the 12 high? I would not. It's a second attempt to resume up. Also, the limit order bears who sold the 13 high needed it to fall 21 ticks to make 5 points, and the high is 98 1/4, and this low is 93.75. So it did not fall enough for the limit order bears who sold the 12 high to make their money. So when it got near their limit order profit target, 5 points below the 12 high, it then did not get there. The bears bought back their shorts, and that caused that tail of 14. Do I still think we're coming down here? I do. Can you sell below 15? It depends. I don't like to sell right above the moving average. So I'm not going to sell below 15. Now, what about buying for a swing? We're always in long. This is a pullback to the moving average, a 50% retracement. But we're not getting good buy signal bars 12, 14. So a lot of bulls are scalping. So to me, you buy the 10 low or 5 points lower or the 3 high. Get your 5 points and then wait for the next trade. For the bears, they're hoping that this is the high of the day, a double top 10, a double top pullback. We had a double top 66.77, pullback 10, but 6 bull bars. Nobody's going to sell the first reversal down. If we get a good bear bar 15, you'll get some bears willing to sell the second reversal down. But as I said, I don't want to be selling just above the moving average. So the bears would need 15 to close at or below the moving average to attract many sellers. Confusing. That pink line, the computers know it. I know it. You know it. But do enough computers know it for it to be a strong enough magnet to get us back down there? We'll find out. Bar 15, a multiple of 3. The bars want 15 to close at the high of the 3 bars, so that it'll be a 15-minute bar closing near its high. Bears want the opposite. The reason I'm leaving these pink lines in is because until we break above 10, there are a lot of computers who are betting we're going to get down there. Did not buy above 12. I did not buy above 14. Bear bars plus, we still have a magnet a little bit lower, so it's not good enough for a stop entry buy. Now, selling below 15, if it's a bear bar, it's not going to be a big enough bear bar. And plus, as I said, if the market's always in long, and we get to sell right below the moving average, right above the moving average, I don't want to take it. Kind of like Friday 37, I would not sell below that. We had a bull surprise and possible bull trend. Probably buyers below 15, buyers below 12, buyers at the 4 high. And for the bears, you don't want to sell below bull bars 10, 15. The bulls don't want to buy with stops above bear bars 12, 14. Limit order trading. Might be forming a triangle here, lower high if we get a higher low. Still always in long. Stop for the bulls right now, unfortunately, is all the way below 4, or below a bear bar closing below its midpoint. Can you get out below 12? We know there are going to be traders buying right here. So if you're long, I would not put the stop below 12 because there'll be buyers here. The disappointed bears who do not think it's going to get all the way here will buy back shorts here. A bad looking sell. So some bulls will buy the 15 low. Other bulls are hoping this is a bull trend. So they'll buy pullbacks to the moving average. This is another test of the breakout point, the 3 high. But the bulls need a good buy signal bar, not 14, not 12. Looks like we're forming a triangle. On a smaller time frame chart, the 8 low may be the first low in the triangle. Let me take a look at a 1-minute chart. Not really good shape, but it looks like we're getting lower highs and higher lows, breakout mode. Trading range days disappoint everybody. Everybody wants it to do something, and very often it'll almost do what you want and then do the opposite. So for me, I wanted to dip at least 1 tick below the 4 high and then reverse up. And then I'll be buying near the bottom of a trading range. I'm also willing to sell at the top, but I want good sell signal bars, which I'm not getting. So for stop entry traders, it's frustrating because usually you don't get what you want. Limit order traders, it's great, but most traders will lose money with limit orders. By the way, I talked about how some limit order bears sold the 4 high, and then they wait for a bear bar closing near its low 11 and sell more below, and then they buy back their shorts here. Others will sell the 4 high and sell 10 points higher, 20 points higher, and then their average price is here, which is above that pink line, and that's probably part of the reason why we bounced there. You had the 10 point limit order bears. They sell 10 points, they sell more 10 points higher, and then their average price is right around here. If 17 is a bull bar closing near its high, that will attract buyers. Second reversal up from the moving average. Every bar today has at least one conspicuous tail. That means every bar today has gone 2 directions. That's trading range trading. That means there are a lot of scalpers taking quick profits. What happens if 17 has a bull body but a 2-point tail on top and it closes kind of in the middle of the bar? Bulls will wait for the next bar. But if 17 closes on the high of the bar, it's a reasonable swing buy, taking a chance that we break above yesterday's high, Friday's high, which is also above last week's high. Everybody's waiting. Whenever you feel like you're waiting, you're probably in a trading range. You always want more information. Nothing seems clear enough, and you're hoping that the current bar will be more clear and that you'll get more information. Outside up bar, bull bar closing near its high, but is forcing traders to buy fairly high up. That's always a problem with outside bars in a trading range. The bull bars make you buy too high if you're a stop entry trader, and the bear bars make you sell too low. So not really ideal. Okay to take the buy. I think it's probably better for most traders to wait to see if we get a second consecutive bull bar 18. Can you sell it? I would not. I'd either be long or flat. We're holding above the moving average. We're always in long. We have magnets above. Most important magnet, high of last week. It's very unlikely that we're going to get up to these magnets today. We have a gap up there. Breaking out above 15, but can we get bull bars closing on their highs? Back above 4,000 all day long. We've been trying to get back above it. I'm going to get rid of this because we're probably going higher. Next target, yesterday's high. Possible measure move up from 4 and 3. It's a slight right above yesterday's high, which was the high of last week. Limit order bears, can they sell 15 high? I'm betting we'll get another reversal down like we got on 10, 11, and 15. I would not. You can see traders are hesitant to buy too high in the developing trading range. What happens if 18 closes on its high and above 15? Then you'll start to get a lot more bulls willing to buy. Bears still hoping to get a second leg down. First leg down 12. They're hoping this is a wedge rally. 3 pushes up, 13, 15, and 18. And then they're hoping for a second leg down. But 18, a bad sell signal bar, like 10 and 15. So nobody's going to sell below 18. And not a lot of traders bought above 17, but it's reasonable. This could be a spike pullback and start of a channel up. And we had that on Friday. We had a spike up, we had a very deep pullback, and then a bull channel. At the moment, I'm flat. For the bears, lower high, major trend reversal, 15 and 18, but bad sell signal bars, 10, 15, 18. So most traders are not shorting here. Bears are hoping that this is a spike down and that we're going to channel down for the next several hours. Bulls are hoping that this is a bull flag, that we have a very strong rally, and that we go sideways and then we get trend resumption up. Best choice for most traders, wait for things to become more clear. This is terrible for stop entry traders. Buying above 12, buying above 14, buying above 16, buying above 17, selling below 15, selling below 18. All of those are losers for stop entry traders and winners for limit order traders. So it's a limit order market. Better to wait for a stop order market. Bears trying to get a close back below the moving average. They're trying to get closes below prior higher lows, 17, 12. They're trying to get consecutive bear bars closing below the moving average. They'd like the second of the two bars to be completely below the moving average. If they get that, then it could become always in short. Bear breakout. At a minimum, I want to see consecutive bear bars, preferably both closing near their lows and both closing below the moving average. And I'd like at least one of the two bear bars to have a body completely below the moving average. If you get that, you're probably going to get a swing down. Consecutive bear bars closing below support, the bottom of a trading range, below the moving average, and both closing near the low of the bar. In the second bear bar, the body's completely below the moving average. Sell the close, probably going lower. Consecutive bear bars. But that's what you're really looking for. Can you sell on a stop below 19, betting that 17, the outside up, is a bull trap? I would not. We're at the bottom of a tight trading range, and we're still always in long. I think the bears need 19 to close near its low, and they need 20 to be a bear bar closing near its low. And that's not what's happening. And because it's not a good sell, you'll get bulls buying. Anything bearish they'll buy. So they'll buy the close of the 19, they'll buy the 17 low, they'll buy the 12 low, they'll buy more lower. Most traders better to wait. I know it's frustrating to sit around and do nothing, but the goal for all of us is to make money. And especially if you're starting out, you should only be trading with stop orders, and you should be waiting for the market to become a stop order market. And sometimes that means waiting 2 or 3 hours, and about 1 day a week, 20% of the time, you get a trading range that lasts all day. To buy above 20, double bottom 12, the bulls need 20 to close on its high and above the moving average. And the bears are hoping 19 is a resumption of the trend down 12. Well, they already have a problem with it. Remember I said the bears want consecutive bear bars closing below the moving average, with the second bar having a body completely below the moving average. I also said it's better if the bear bars close near their lows, and 19 did not close near enough to its low. So it still looks like a trading range. To buy above 20, it already has a problem. It's too big. And even if it closes on its high, it's similar to buying above 17. You're buying too high up in a trading range. So not a good buy. You can see the 19 high is 1 tick above the 18 low. And why did that happen? Because 18 was a bad sell. Some bulls bought the 18 low and bought more 5 points lower. Others simply bought 5 points lower, betting that it would get back above the 18 low. And it did, by I think 1 tick. And the bulls sold. And that's why we have that tail on 20. And the bears knew the bulls would do that. So we had limit order bears selling there as well. Marcus deciding. Remember I said early on that I thought we'd get a double top pullback, double top 66, 77, and then if we get a rally, it probably would form a lower high. And this is a double top pullback 10, second and third entry here, but we're not getting good stop order entries. So most traders are better off flat. Bears trying to get down. We just broke below 12. They're trying to get down to that 5 high, bad buy signal bar. And there really are some bears who are still short from the 4 high, taking a chance that we're going to get there. I removed that 50% target. So some bears sold the 4 high, some sold below a bear bar closing near its low 11, and we're already below that. So the bears have patiently sold here, sold more with a stop here. They're able to get out without a loss here, but they're trying to get out, break even on their first sell, and then a profit on their second sell. Getting a breakout below the trading range, but can the bears get consecutive bear bars, closing near their lows and below the moving average, turning this into always in short? Remember what I said on the open? A third consecutive by the close rally lasting 4 hours is unusual, less than 20% chance. That meant 80% of the time, a rally like this is not going to be the start of a big bull trend. Bears are hoping that we get down to the start of yesterday's channel. We had a spike pullback channel. They're hoping to get all the way down here. Well, I don't have a strong opinion other than we've been in our trading range now for about 70 bars since 48 yesterday. Failing repeatedly to break back above 4,000. Remember, I've been saying since last year that 4,000 was a really important price. Here's the 4,000 area. We gapped above it on the daily chart, the weekly chart, the monthly chart. Remember, this is a continuation chart of the E-mini. So the prices we have here were not the same prices that we had last year at this time, but it was around 4,000, and we just flew above it. We tested it, and I said it was unlike all the other big round numbers where we went above and pulled back. Here we just went above and kept going up. And I said we would come back to it and probably spend a lot of time going sideways around it, which we did. Here's the monthly chart, and here's that area, 4,000 right here. And we were sideways here for many, many months. Very big bear surprise bar. Looks like we're going to get at least one tick below the 4 high. Bears are hoping this is a trend reversal. We rallied strongly, and now we're reversing strongly. Can you sell at the market, arguing it's a bear surprise? So even if we reverse up on 22, we'll probably get a second leg down. That's probably true. So you have traders willing to sell at the market, betting that even if we start to reverse up, it'll be a minor reversal. The bulls repeatedly tried to break above 4,000 in yesterday's high and failed. And when the market tries to do something 2, 3, 4, 5 times and is unable, a lot of the traders decide that maybe it's the wrong way and that we're going the opposite way. So a lot of the bulls who were buying, at some point they decide it's not going to happen and they give up. And 21 is a give up bar. The bull is giving up. Very good bear bar, right near the target, the 4 high. Can you buy 5 points below 12? It's a trading range, so limit order bears tend to get rewarded. So the bears who bought the 12 low, bought more 5 points higher, they'll probably make money. They'll probably get above that 12 high within the next several bars. Right now, even though we only have a single bear bar, not 3 consecutive bear bars, 20 is a bull bar, it's probably always in short. I think the bulls are giving up. Big enough bear surprise so that we'll probably go at least a little bit lower. And you can see we're testing that bad buy signal bar high. You think that's a coincidence that we're right there? Nope. We should get at least 1 tick below it. Because of that bear surprise, we'll probably get closer to the low of the day, maybe even break below the low of the day. Trading range, you expect a measured move, and there are many ways to draw it. I could use this low or that low. I could use any of these highs. So those measured moves are areas where traders will buy. Traders will buy back shorts, and bulls will buy to get long. I talked earlier about how we had a small Goldilocks range and we could go both below its low and above its high. But sometimes, I don't know, a few times a year, you get 3 breakouts of the Goldilocks range. We went below the low, or above the high, and we could easily go below the low again. That's unusual, and it's more likely to happen when you have a small Goldilocks range like we had last night. But pretty good momentum down. On the day session chart, we have a magnet down here. So the bears have a decent chance of breaking below the Goldilocks low again. Anybody selling here, stop at least above the bear surprise 21, maybe above 18, and better if you can sell more 5 points higher, 10 points higher. So that means you have to trade very small. I'll get rid of that line at the 4 high. Bear surprise. We had a bull breakout, a bear breakout, a bull breakout, a bear breakout. So lots of reversals. Now we're always in short. Traders are selling for any reason, but you need a wide stop. Bears are hoping that this is a spike down, and if we get a reversal, it'll form a lower high, and then we'll get a channel down. That's what is likely to happen. Below the Goldilocks low, above the Goldilocks high, and then strong breakout below the low, and then bear trend. Above the high, below the low, back above the high. Globex above the high, below the low, back above the high, and up for a measured move based upon the earlier trading range. Below the Globex low, above the Globex high. Most days you only break out of one side of the Globex range. Sometimes the breakout does not come until the very end of the day. So 90% of the days you break out of the Globex range. And here we did not go below the Globex low. And at the end of the day, we finally got above the Globex high. Another example, the breakout did not come until the end of the day. Here's a downside breakout. It came during bar 80 right at the end of the day. But 90% of days you break out of the Globex range. 10% of the days you don't. Try to get below the Globex low, unable. Try to get above the Globex high, unable. Try to get below the Globex low, unable. Try to get above the Globex high, unable. Any reason to buy here? Well, tail 22, so not great sell to close, but I think it's a big enough bear surprise that traders will sell the first reversal up. Now, when we broke above 3, I said we're probably going to dip below the 3 high because it's probably not going to be a small pullback bull trend. It'll probably be a trading range. And we did. 12 fell below the 3 high. We broke below 12. Do I think today is going to be a big bear trend? It looks like a trading range. And excuse me. When the market's in a trading range, it tends to pull back below breakout points. So we're probably going back above the 12 low. Because traders will think it's a trading range. And if they think it's a trading range, that breakouts will fail. So they buy the 12 low, buy more 5 points lower, buy more 10 points lower, betting it'll get one tick above 12, and they can get out break even on their first buy and with a profit on their lower buys. And that means bulls will sell the 12 low. The bulls who bought the 12 low, bought more lower, are going to exit around the 12 low. Bears know that, and they'll sell up there as well. Bears, they can sell the market, sell the close, sell above bars, sell above 22, or sell the breakout point, the 12 low, or sell the moving average. All of those are things that the bears will be doing. The bears who are currently short are aware that there's a big magnet at the 12 low, and some of them are buying back shorts here, or they'll buy back shorts above a bull bar 23 if it closes above its midpoint. But as I said, probably sellers just above that 12 low or right around that 12 low in the moving average. So swing bears do not have to get out. They can hold short, stop above 18 if they're trading small. If they do get out above 23 and then we get a bear bar 24, they can sell again below that bear bar. We're getting near the end of the second hour, and we're determining the appearance of that second bar. And so far, it's an inside bar. It's a bear bar, but an inside bar. And it looks like we're forming a trading range. So it increases the chances that we're not going to go far down. Increases the chances that we'll probably be sideways for a day or two. Is there any reason to buy above 23, a high to 12? I would not. I'd want to see a liquidable bottom or 2 or 3 consecutive bull bars. Probably sellers above around that 12 low. Low 123 for a bull bar. Low 124. If it's a bull bar, it'll reduce the number of bears selling below 24. Increase the chances there are buyers below 24. Right now the market's deciding, is this a bear leg in a trading range? If we get above the 12 low, then probably is. Or is this the sort of a trend down, a spike and channel bear trend? If we do not get above that 12 low, then we're probably going lower. Right now I think it's more likely that we're going to go at least a little bit lower. but one or two more bull bars, and then the bull case becomes better. This could be simply a deep pullback from this, like we had on Friday. Big rally, deep pullback. Today, big rally. The bulls are hoping deep pullback. It's more likely that we're going lower. Head and shoulders top, left shoulder, head, right shoulder, double top, pullback, and good pair of bear bars, probably going lower. Low one, but only a bear doji and fairly far below the moving average. So there may be buyers below 24, and we may have to get closer to the moving average before we continue down. Anybody selling here, you still need a wide stop up here or here. Outside up, but still more likely we're going to get more of a second leg down. US dollar closed bulls 22, disappointed 23, placed limit orders to get out break even, and they got filled on 25. And that's part of the reason that 25 bounced. And you also had bulls looking at 24, a bad low one, and we're still possibly in a trading range day. So they bought the 24 low, betting that we'll go up 5 points and possibly above the 12 low. Markets deciding, is this entire sell-off a pullback from this rally and that we're going to get a bull trend? Or is it the start of a bear trend? Or is it simply a bear leg in a trading range day? The size of 25 reduces the chances that this is going to be a significant bear day. So far, trading range day, lots of limit order scalping. That's not what the bears want. So it's probably not a bear trend. And now it's either a trading range day, which it has been all day, or the sell-off from 10 is simply a deep pullback, like yesterday. Bar 25, we ended up beginning a bull trend, and the bulls are hoping bar 25 today is the start of a bull trend. It is still always in short. Not if it closes up here. If it closes above the moving average, it's probably always in long. Breaking above 21, probably always in long right now. Excuse me. So now it's back to either a trading range day or a bull trend. Can you buy the market? Only if you can use a wide stop. Because it's a big bar in the top half of a trading range day, some bulls, instead of buying the 25 high, will place a limit order to buy maybe 5 points down, maybe at the moving average, maybe at the 12 low. And can the bears still be short? I don't think so. I think most bears gave up during 25. Some gave up at the 12 low. Everybody's taking quick profits, trading range day. Another lower high 26, but the best looking trend bar all day. So probably buyers below 26, probably always in long. I would not sell below 26, even though lower high, impossible. Bull trap, more likely we're going to get a second leg up. Bulls trying to break above 4,000 and above last week's high. Suppose 26 looks like 11, and then bulls will wait and not buy the low. If 26 looks like 18, a bull bar, they'll buy the 26 low, they'll buy the moving average. There's a lower high in a bear channel, possible triangle, lower highs, higher lows, but probably buyers 26 low, buyers at the moving average, buyers 12 low, buyers 50% retracement, so I would not sell. But not good for the bulls. Everybody wants a trend, but so far it's a trading range day. Several reversals. Anything bullish, they sell. Anything bearish, they buy. And they scalp. They take quick profits. Failed repeatedly at 4,000. We reversed down strongly, but we reversed back up even more strongly. So I think we're probably going to get above 4,000 and test yesterday's high, last week's high. There's lower high in a bear channel, but the best looking trend bar in either direction all day, and reversal up. So we're probably going to get at least a small second leg up. High one for the bulls for a doji bar. If you buy above 27, you're hoping that we break strongly above 4,000. So you're hoping for a swing up. But the bulls will be quick to take profits if they do not get a big bull bar. Bears want a second reversal down or a micro double top. We had a micro double bottom here, but no good stop entry buy. Bull scalpers, 26 low and at the moving average, are scalping out 5 points around 4,000. Bears are trying to get a micro double top, 26, but then they need a good sell signal bar. I did buy the 26 low, and I placed a limit order to get out with 5 points, and I'm back to flat. I've been scalping until I think the market is in a trend. I usually just scalp. Now, I said nobody's going to sell below 26. They might sell below 28 if it's a decent looking bear bar closing near its low. I think it's more like 15. If we get a reversal, it's probably going to be minor. I think we're going higher. At this point, I said I thought we were going to get a double top pullback, double top 66.77, and the rally 10 pullback. And we got a brief bear trend down to 22. So I think the double top pullback has done all it's going to do, and now we're moving on to something else. And the bulls are hoping that 22 is just a deep pullback from a strong rally, and that the bull trend is resuming. So they're hoping it's a spike pullback channel. Right now it's a trading range day, and everybody's still scalping, taking quick profits, breakout mode. Always in long, still on the buy above 25, or at the market on the close of 25. But I would get out below 28 if it has a bear body. What happens if it closes above 4,000 and above 26? That would increase the chances that we're going to get above Friday's high, which I think we're going to do. Micro double top at 4,000, but very strong reversal up 25. I think we're going to finally break above 4,000, so I would not sell below 28. The bulls, they can get out below 28, they can get out below 27, they can get out below a bear bar closing near its low. I think there probably are buyers below 28, buyers below 27. So I would not, if I were still long, I would not get out below 28. I would not get out below 27. I might get out 5 points below 27 down here, but not at the 27 low. Right now, it looks like we're going to go higher. Can you sell below 29? If 29 closes near its low, which it did, well, I don't know. I would not get out below 29. Maybe get out 2 or 3 points below 29. The bulls are looking for a high one. They want a bull bar. 29 is a high one, but it's a bear bar. So we're repeating what we did over here. Disappointing follow through after a strong rally. And here, the bears won. Right now, I still think it's more likely we're going to break out above the high of the day and probably above yesterday's high, Friday's high. What happens if the bears get a big reversal down like 21? Well, then it'll become bearish again. But right now, it's slightly more bullish than bearish. Still a trading range day. still breakout mode. But the most recent strong move was up, so it's slightly more likely that we'll go higher. The bull's a high one. We have a new high of the move, 28. Pull back 30. The more bullish 30 is, the more bulls will buy above 30. The less bullish it is, the more they'll wait. Maybe we'll go sideways more, or they'll buy a breakout above 28. I would not be short yet. Bulls hoping to get 30 to close on or near its high and be a credible buy signal bar. And can you buy for a swing or a scalp? Everybody takes these buys for a swing, hoping that we get a strong upside breakout, knowing we probably will not. And then they quickly scalp out 5 points. In bears or bulls, I would not get out below 29. Maybe get out 2 or 3 points below 29. If 30 is a bear bar closing near its low, get out below 30. And for the bears, I would not short despite the micro double top and the lower high. 25 is the single best looking bar in either direction all day, and it's a reversal up. Still pretty disappointing. Pretty disappointing. A bull doji, high one. I think it's not a high probability buy. If you buy, I think you still need a wide stop, at least a couple points below 30. Can you sell the 30 high? Betting that we're going to continue to fail at 4,000. I think it's not bearish enough yet to do that, so I would wait. Can you sell below 30 upside down? I would not do that either. I would wait to see what 31 looks like. Probably bull flag and not trend reversal. So probably either we go up above 30 or we pull back a little bit more, maybe get a wedge, 26, 30, and then maybe 32 or 33, and then a decent bull bar. But I would either be long or flat, and I would not sell right here. I don't think today's going to be a big trend day. The range so far is about 30 points. It's possible it could double. I don't think it will. So if we do get the breakout above 10, I think it's not going to go up for a measured move based upon the height of the range. For the bulls, it's a double bottom, 4 and 22. The bears have a double top, 10 and 28, but slightly more bullish than bearish. I'd either be long or flat. And until it becomes clearly trending in either direction, I would only scalp. Okay, I'm going to head out. Right now, it's more likely we're going higher. We'll try to get above last week's high. On the weekly chart, the week closed on its high, so we'll try to get above it. But I don't think we're going to get a third consecutive dramatically strong bull day. But strong rally Thursday, strong rally Friday, sideways, probably a bull flag, so probably going at least a little higher, possibly today, but unlikely that we're going to get a big sell-off today. Okay, I'm going to head up. Hope everybody has a good day.